Okay. Hello, everyone, and welcome to today's Angel Connect session. Thanks for making time to join us. We'll be starting in a moment, in the next couple of minutes. In the meantime, feel free to introduce yourself in the chat if you'd like, and maybe mention where you're dialing in from, how it is where you are, whether you've already caught up with the US elections. But feel free to introduce yourself in the chat. We'll be starting in a couple of minutes. We have an amazing session ahead of us today. So welcome to everyone who's been able to join us. I am sitting in Nairobi, and glad to see everyone who's been able to join us. Yeah, so it's been some time since we've connected with our alumni. So really happy to see a couple of familiar names that have been able to join. We will be starting in a bit. So feel free to just type something in the chat, introduce yourself, where you're at, before we get started in the next 2 minutes. And I hope you can hear me well. I think the numbers are picking up before we get started. If you're new to the conversation, you're being hosted by the Africa Angel Academy. And we have these conversations every quarter to make sure that if you're part of our alumni, if you're thinking about joining the angel investment ecosystem, you get an opportunity to keep in touch with some of the topics which are making headlines, which people are thinking about. And certainly, this is one of the topics that I think is an important one in the current time. Really excited to moderate the conversation and, of course, to work with the different panelists who are going to be joining the conversation. Samuel, I am well. I hope we'll be seeing you at the Capitalise Investment Summit in Cape Town. That's a place to be later on this year. From Fiona, what are the dates again? Is it 27, 28?
So we'll be having a really nice alumni mixer on 27th, and the summit will be happening on 28th and 29th. So alumni, get ready.
Yeah. I'm looking forward to host you guys if we get to Cape Town. And I hope I don't have any background in my. Fiona, can you hear me well? Crystal clear?
Yeah, very clear.
Okay. Brilliant. I think we'll get started in the interest of time. The session is being recorded, I think, Fiona?
Yes, it's being
Okay,
recorded.
the session is being recorded, so I think we can get started.
Mm-hmm.
My name is Stephen Gugu, and I'm one of the facilitators at the Africa Angel Academy. And I'm really excited to be hosting you today in the evening. I'm also an angel investor with the Victoria Business Angels Network, which is based out of Nairobi. And I'll speak a bit about what the Africa Angel Academy is and Victoria Ventures. As mentioned, we're delighted to have you. If you'd like, feel free to introduce yourself in the chat section and just mention where you're dialing in from. Always good to know where the different people are coming in from before we get started. So in terms of our agenda for today, we have a very quick agenda. The Angel Connect is meant to be a knowledge sharing session, a connection session. So we are just going to speak a bit about the Africa Angel Academy. For those who may have joined us and they don't know about the Africa Angel Academy. After that, we have a powerful session with three really good speakers, where we'll be diving into the topic of the day, which is investment and tech deals, or navigating investment and tech deals. And I'm really excited about this. I'm going to be taking notes because I think I'm going to learn a few things out of this. Once we're done with that, we'll have some special announcements, a couple of special announcements at the end, and then we'll close at 7:30 p.m. That's Kenya time. So let's get started. So just to get started, the Angel Connect series, as I mentioned, is something we organize at the Africa Angel Academy. And we put this together to make sure that after you've gone through any of our cohorts, I know we are already at cohort 10, and you're an alumni, or if you're interested to think about angel investing, this would be the place that you'd be able to come and you'd be able to learn more about some of the topical discussions that angels are having, investors are having. And so we've had several sessions that we've engaged with previously. The whole idea about this session is about to connect, to engage, and to share some insights. Some of the past editions that we've had have been on different topics. I'm just trying to get a slide. So some of them we've had on just discussing the secondaries market. We've had discussions just about future of angel investing and so forth. And we're always just trying to stay ahead of the conversation so that as you then, come in for these sessions, as you continue with your journey, you have a place to be able to connect with us. If you don't know about the Africa Angel Academy, a couple of things about the Africa Angel Academy. We are the first African Angel Academy created by Africans for African angels. So we are based on the continent. All the content is geared towards the African continent about investing as an African angel investor into the continent. And so far, from an experience perspective, we've trained over 713 angel investors. We've had 10 cohorts completed. We're very proud about the last cohort that we had, which was over 80 angel investors, all female angel investors who were trained, went to that cohort. Our angels have come from 26 African countries, and out of that, we've had 24 angel groups that have been mentored through the support of the different development partners that we engage with. We have had over 40 master classes in different topics ranging from valuations and negotiations, exits, and so forth. And we're very proud of that 48% of our participation has been for female angel investors. So we are hoping that we'll be able to tilt the scales in terms of how investing is being done and how lopsided that is. So very proud of that statistics. We've had over 40 angel networks across the continent being represented, and over 70 speakers have been part of our session. From an implementation perspective, the Africa Angel Academy is implemented by Viridian, which is a South African advisory firm that designs and delivers early-stage entrepreneur and investor programs and research and strategy. And the Victoria Business Network, which is based out of Kenya, that makes investments across the continent, but for startups looking to invest, for startups which are looking to expand into Kenya or that are based in Kenya. We're trying to expand our reach to make investments also in startups in East Africa. And so through the content in the Africa Angel Academy, we try to share as much as possible the experiences that we've gone through. So in terms of just our flagship program for the Africa Angel Academy, we have 14 online video modules that have been developed. So it's usually flexible on demand. You can go through it online, but you also have the option of doing through it in a cohort-based program, and that's why we spoke about the 10 cohorts that we've already had. How we structure the cohorts is that you start and you have a 12-week period through which to finalize the modules. Through that, we make sure that we have Q&A sessions where we feature different angel investors from across the continent to share their own experiences. We're also able to feature some master classes on different topics, valuations, negotiations, exits, and so forth. And the good thing is that by the time you're done with our 12-week program, we also showcase some startups that are looking to fundraise that you can make investments into. And through that, we've had a couple of investments being made by the angels in the past of the different cohorts. We also have networking sessions across the 12-week module period. So when you do the Q&A sessions, we always ensure that we give you an opportunity to get to know the other people who are part of the cohort that you're participating in. So if you're new to this and you'd like to join that, we'll be speaking a bit more about some of the programs we're looking to launch later in the year. So feel free to join us for that. Some of the other things that we do for the ecosystem is that we have a number of angel group case studies. So if you go to our website, the Africa Angel Academy, you should be able to find a number of case studies on different topics, some of them on angel groups. So these are some of the new case studies that we launched earlier this year if you want to understand a bit more about the journeys of some of the leading angel groups in the continent, Naiban, Josie Angels, Rising Tide, you'll be able to read more about that. We also have some case studies on startups where angels have exited. So just to hear the journey of the different angel investors. We also have some technical notes if you want to get access to some legal guides to understand how to make investments. I think so far we have for Kenya, Ghana, Tanzania, Uganda, Nigeria, South Africa. I think I may be missing one or two. So if you want to get access of those, you can just step into our website and be able to get access of those. So we're happy that you're here. And without much further ado, I'd like to invite my three panelists for today's session. So Anne Juki from Sayuni Capital, Steve from Desiree Ventures, and Aurora Badi from Yundo Capital. Thank you so much for joining us for today's session. So I am going to get started with the session. So let me just stop sharing my screen. As mentioned earlier, we are looking to have a conversation about investing in non-tech field, at least navigating investments in non-tech field. So I'm going to ask my panelists first of all to introduce themselves. I'm going to start with Anne, then I'll move to Steve, and then finally to Aurora. And as you're introducing yourself, you can probably share a bit more of a background in terms of what you do in the early stage investment space, and also if you have some experience around investing in tech field. So Anne, we can start with you, and then we'll move to Steve.
Thank you, Stephen. Good morning, afternoon, evening, everyone, depending on what corner of the globe you're in. My name is Anne Juki, and I am founder and managing partner of Sayuni Capital. Sayuni Capital invests debt in profitable SMEs across the consumer goods value chain. And that's everything from light manufacturing, agribusiness, distribution and logistics, as well as retail of consumer goods. So everything from when you need to manufacture, process, distribute, or sell a consumer good. Sayuni operates in Kenya and in Tanzania, as well as opportunistically in other markets in East Africa. Prior to founding and starting Sayuni Capital, I worked with DOB Equity, which is a Dutch impact fund in Nairobi. While there, I made investments in both tech as well as in non-tech businesses. I am also an angel investor and a proud alum of the first cohort of the Africa Angel Academy.
Thanks, Anne. I'm glad that our alumni is coming back and supporting us in the journey to ensure that we build the next generation of angel investors in the continent. Steve Tawia, over to you.
Thank you. Can you hear me well? I don't know my sound is good. Yeah.
Loud and clear, loud and clear.
Excellent. Thank you very much. So my name is Steve Tawia, Ghanaian, French, actually, also. I'm currently the managing partner of Desiree Ventures. We're a digital health, medtech, biotech, and assistive technologies venture capital fund for Africa. We're based out of Nairobi and Kenya and Ghana in Accra. We're essentially a pre-seed seed to Series A investor, and we've invested in 9 portfolio companies so far, all of them in tech. But I've had the opportunity as an angel investor to invest in both tech and non-tech deals through Asime Ventures, and also in terms of institutional investing through various positions I've had over the years, from private equity, small cap, large cap, institutional investment at ACF and other places. So really looking forward to have a conversation. And I happen to have been the one selected to do the non-tech deal module on the AAA. So please, please, please make sure you register to be the next cohort of angel investor. You see my face if you choose a model. Thank you.
Steve is already letting the cat out of the head bag. That was a special announcement. But thanks, Steve. Actually, indeed, yes, Steve has supported us in recording a module on investing in tech deals. So we'll speak more about that later on. Okay, and then last but not least, Aurora. Aurora, if you could kindly unmute yourself.
Yeah, thanks, Stephen, for the introduction. My name is Ara Badi. I work as a senior partner at a Dutch-based investment PE fund called Yunko Capital that has been investing in Uganda, Kenya, Rwanda, and Tanzania as of last year, from 2017, mainly doing a hybrid of debt and equity investments, although there is a preference for debt as the first point of entry, with ticket sizes not going above $500,000, a minimum of $100,000. So we have invested close to about 22 million across the markets, with Uganda and Kenya taking lion's share of that. Invested across 50 companies, exited almost 8 companies. We're quite sector agnostic, learned quite a number of lessons, and unlearned a number of mindsets we had. And prior to that, I worked at an MFI that was doing microfinance lending. Then prior to that, I worked for one of the big four as an accountant and as an auditor. And then prior to that, I just practiced accounting. So it's a pleasure to be here. Thanks, Stevie.
Thank you very much, Roro. And I think we can jump in. As you can tell, we have a pretty experienced panel in terms of making investments, both across just any investment, but especially in investing in tech. So I'm going to start with you, and I'm going to ask everybody the same question. My question is it angel investing if it's not investing in technology, in tech, right? And I'm just going to stop there just to hear what your thoughts are on that.
Yeah, an interesting question, Stephen. I guess if there is one, a funding need, most likely two, a value of death, and three, an exit, or at least hope of an exit, then absolutely it is investing, and it is still angel investing, regardless of whether it is tech or a non-tech company. I think that and we'll talk about it later during the session, I hope, where I think there is capital flows, and you do find that people are, I think, have a clear, particularly as an investor, you have a clear path to value addition, as well as to exit, then absolutely still an angel investment, whether or not you're investing in tech or non-tech.
Okay, thanks, Anne. Steve, as I come to you, part of the reason I'm sort of pushing on this question is because for quite a bit of time, most of early stage investing in the continent has been focused on technology. And I think the discussions are going on in terms of how we copied, the Silicon Valley model and, dropped it onto the continent. So that's what we've been using quite a bit as the definition of early stage investing or tech investing and so forth. So with that context, Steve Tawia, what else can you add to the same question?
In fact, I wanted to go back to the definition of angel investing. Actually, according to various sources, it originated in Broadway in New York, where people needed a show to be financed to go and deliver on Broadway because not many people wanted to finance these particular shows. And so a lady called Willis, I forgot her surname, started to say, look, we need angels, nice people, instead of devils, angels, to finance these Broadway shows. And this is how progressively an angel investor shifted from financing a Broadway show to be a providential investor that supports any other industry. And so I think that idea, if you look at the fundamental of an angel investor, remains, right? It started actually as a non-tech investment to be more looked at as a tech one, but actually the origin of the word is actually non-tech investment.
Some history lessons there. Thank you, Steve. Aurora, just coming to you. And the same question, but with a slight twist. At Yunko Capital, you've always made your investment with an angel investor in mind. And I think you've been, I think when I met with your founder, Roland, he was very clear from the beginning that you would always be doing the non-tech deals. Actually, it's very clear about that. And maybe just coming back to you, and then the same question, and bearing in mind what you've learned over the last couple of years making investments in tech deals, how would you answer the same question, Aurora?
Yeah, I mean, you're spot on. We always invest alongside an angel investor. The portion has to be maybe the same, but something substantial. But to answer the question you did put across, I think angel investing is it's something that has been in our spaces over a long period of time before the label angel investing came. Majority of our seasoned entrepreneurs raised capital from either family members or one or two friends that were willing to take a leap of faith and thought or bought into the idea that you're putting across. So I think it's not tied down to a sector. I think it's more around the model and the goodwill around capital provision to entrepreneurs. So we have realized that there's a lot of capital that's stuck within our markets. And the main reason for this is because of lack of opportunities or a slower return on the more legacy investments of real estate and land, that people are always looking for where to put their money. So what we always share with them is we give them a brief of an investment opportunity, and we give them the same rights as ourselves. And what we have realized is there's been a lot of reception towards those investment opportunities across sectors, different ticket sizes, and different returns. And of course, some work out, some struggle along the way, but at least there's always been a reception and appetite for these investment opportunities from the angel investors.
Thanks, Aurora. And just staying with you, why have an angel investor as part of the deal? You're an institutional investor. You could fund the deal, you can do the DD, you can manage the deal. Why have an angel investor as part of the deal?
There's the one aspect, of course, it gives these angel investors an opportunity to invest in these companies. But then from our spectrum, we look at it as this is a local investor, probably has a better understanding of the sector or the company in which you're investing. And then also there can be some value addition that they can add to the business that typically we may not be able to. But then also most of these entrepreneurs need some sort of mentorship. So the angel also can come in that regard, something like a mirror that the entrepreneur can bounce ideas off along the investment journey. So those are the two angles that we look at it, and one or two have been successful. At times, both have been successful in terms of support to the company and also the angel investor getting a good return.
Thank you. And just coming to you, Anne, you've made investments both in tech and non-tech deals. I guess wearing your angel hat now, just for a second, why should an angel care about investing in tech deals?
Yes, so I think there are a couple of reasons. I'll highlight two. One is that any investor needs to have a balanced portfolio, and the risk-reward profile of a tech deal is significantly different from a non-tech or an SME deal. And so I think ideally you'd want to have a mix of both, particularly, for example, as we've seen over the last 18 months or so, there was a devastatingly cold funding winter where a lot of tech companies were, if not all tech companies were affected, laid people off, valuations tanked. And so if you had a portfolio of tech investments, chances are that dipped. But then if that was balanced with, a few non-tech investments, then, chances are they had much higher probability of surviving the funding winter. They are certainly less likely to be very high return, but at the same time, they are less likely to tank, statistically speaking. So I think one is just a balanced portfolio. Second is that both a healthy ecosystem needs both tech and non-tech companies. So you find that, for example, a lot of SMEs are reliant on tech solutions to enable them to run efficiently, to enable them to scale. And at the same time, your typical tech companies will need non-tech companies and SMEs, which are a significantly larger part of the economy, to form a stable customer base for them. And so you need a mix of two in the ecosystem. And I would argue then you also need a mix of two in your portfolio as an angel investor.
And I like that. Actually, that's an interesting point in terms of making sure that you have a balance, because most technology is often deployed also in non-tech companies, so to make them a bit more efficient and so forth. So that's an interesting perspective. Steve, on the same question, and maybe also broadening the question a bit. So for you, why should you've made investments in tech and non-tech deals. Why did you make investments in tech deals? And maybe just furthering the question, what value add, or what do you think you were able to add in the non-tech deals based on your experience in some of the tech investments that you've made in this case?
I love this question because actually my first investment as an angel was in a non-tech deal. So the story goes, I sitting in London at a dinner. There were a number of Ghanaians there. A Ghanaian lady, British, black Ghanaian, came up to me and said, "Look, yeah, I want to start up this company. I want to start this company, and I'm going to do Ghanaian food originally, but as she expanded to African food to take away in London because we as African we don't have any fast food. So she started doing what she called chop pots. Basically, it's jollof rice, beef stew, chicken stew, etc. in pots, and then starting to distribute in the Tesco's, the Sainsbury, equivalent to the Neighbours, etc. in London. And I was really attracted to that. And that was my first angel investment. So what I would say to your question is that both for tech and for non-tech deals, for me as an angel, the fundamental is you need to have a fairly good understanding of the business. What is it that the entrepreneur wants to solve? And you need to have some relatedness to it, right? So what I advise people who are not techies is either you know somebody who knows or you do the work to know. I'll give you a very striking example on the tech deal that I ended up doing. During COVID, I had time on my hands. I taught myself two things, cybersecurity and AI and machine learning. That means that the year after, I was thinking, actually now I'm equipped to be able to assess AI machine learning companies, not all spaces, but at least I have a strong baseline to do cybersecurity as well. So I started looking at companies, cybersecurity and AI. Again, because I could relate and understand the product or the service. So again, fundamentally, that's for me is a critical element that makes you make a decision to invest in a non-tech deal, but it's the same. It applies to the tech deals as well.
And Steve, just maybe the second part of the question, which I asked, and I'll come back to you, and before we move on to Aurora, what experience? You've made a lot of tech investments. What kind of experience do you think an angel investor who's been doing mostly tech can take to the non-tech side, both from an investment perspective in terms of how to make investments, but also just how to support some of these portfolio
founders? Yes, the support. Yes. Okay. I forgot the last part of the question. Actually, which was the hardest one, actually. So in that particular investment, it took me about 8 years to recoup my capital. And the company had two instances of near death, right? One, the kitchen burnt, right? And the founder was in hospital with a medical problem for 6 months. And so you need to have strong nerves. That's one thing I would say, that is an experience you need to have and transfer the other side. Okay. Number one. Number two, I think, beyond the technicals of it, I think is a lot of empathy, right? I spend tremendous hours on the phone visiting the founder and really coaching from the little I know, the entrepreneur. So when we say, and one of the things I would say, which is a big difference for somebody who's doing tech deals versus non-tech one, is that your experience as a tech investor needs to really focus when you want to transfer some of the skills into really building financial models, obviously, but really trying to figure out a way to be much more hands-on in the operation and asking the right question. I think the questioning from a tech perspective is the one that I can bring in. And number two, I would say, if you're a tech investor, actually a non-tech deal can have a lot of value created by you because you bring the tech enablement to the non-tech deal. So if a company doesn't have proper supply chain in place or proper marketing and communication or proper internal processes, instead of them going to buy Oracle or Sage, you can help them buy, I don't know, WorkPay or another tech solution that is tech driven, but is not the typical brick and mortar or click and brick solution for that. I think the digital transformation of non-tech deals is another aspect to it. Yeah.
No, thanks, and I like those 2 points. Two very, very good questions, and this digital transformation angle. And what else can you add in terms of what? And the beauty about it is that you've been doing this already. You've been investing in tech, you've invested in tech. What have you done in terms of just taking some knowledge on this side or experience and applying it on the other side?
Yeah, I mean, I really like Steve's point around empathy, because I think that the highs and lows of entrepreneurship are, actually not unique to either tech or non-tech enabled deals, right? It's extremely hard to be an entrepreneur, and I think bringing that sense of humanity and empathy is quite important. I appreciate that a lot more now as a first-time fund manager, because you are also an entrepreneur. That's one. I think two is, often for a lot of early stage companies, regardless of whether they are tech or non-tech, they still require support around a number of issues. So some common things I've seen are, I think one, governance unfortunately tends to be, governance and controls, I think, tend to be really poor, not across the board, but generally speaking across both tech and non-tech companies. So understanding when you invest that, for example, if you're investing in a non-tech company, chances are it's owned and run by a family or husband and wife team. You sort of make decisions around the dining table. Nothing is documented. Accounts are audited by their cousin. Like there are a lot of these things where you realize, controls are poor, governance is poor. But once you spot a good company, then it's worth really taking the time to help them think through, okay, these are the advantages of making decisions a certain way. These are some of the risks that you might avoid taking if you bring in, one or two external advisors. And sometimes it's gradual, right? So you don't want to force them from being a strictly family-owned business to then having a 5-person board. Just say, look, we need help on how to put in, like, so Steve said, maybe technology. Have you thought about bringing in someone who is not on your board and is not on your CR12, but they can help you, speak with them once a month or once a quarter, they can help you. So I think having that sense of what a company needs and graduating them there slowly has, I found to be, quite a helpful way to approach supporting the companies, and not having a copy-paste template of how you do things as well.
Yeah, no, thanks, Anne. And I mean, I'm just going to add just a few points also, just from things that we've seen from our side. We found that some of the some of the tech deals we've done a lot of BD for them from the non-tech, not portfolio, but also advisory business that we've worked with, and has been very useful because you find that I feel like people exist in different worlds. It's like you have the tech guys who are the cool kids in the block and so forth. Then you have sort of like the traditional people and they're doing their own thing. And at times they don't think so much about it. And you being in the middle and being seen as an expert, quote unquote, you can be able to introduce teams across and to like, okay, interesting, they can do that. Let's try and see what happens. So I found that to be very useful in our portfolio at least. And maybe Aurora, just bringing you in. You've been doing this for some time. You've been working with angel investors as part of your portfolio. 2 questions. One is, what have you seen that the non-tech companies that you make investments usually need from an angel investor? And in what situations have you sort of like created relationships that you thought, that was very useful. That is exactly what the relationship we intended when we were bringing an angel investor to an untapped deal. That's exactly what we needed when magic happened. If you can share any stories around that, that would be very useful. Aurora?
Yeah, thanks, Stephen. So, I mean, the angel investment does require a lot of patience, and it's pretty much the same whether it's tech or non-tech. The kind of support you can offer these entrepreneurs outside of the capital that you've given them, especially when things are not going according to plan. But the one thing that we always ask our angel investors is, if I may borrow from, I think it's Game of Thrones, you have to be the company's champion. And that requires you doing an ambassadorial role for the business. So try and see what opportunities are out there and share the scope of the business, because you never know what kind of opportunities that would open for the business. It's all about network. Those are markets that we live in Africa. So you know someone who may know someone who could give you an opportunity that probably, if you had kept quiet about the investee, that never would have come across them, or something that not be aware of. So I think one, be a champion for the company that you've invested in. Two, I think I hinted at this initially. We always ask our angel investors to have at least a quarterly catch up with the entrepreneurs. And it's not so much that you have to go and give them the A to Z of how to run the business. At times, as human beings, just having someone listen to you and just to share your thoughts. So more of a mirror conversation. You don't have to have any serious inputs. Just, yes, maybe, I think so, I see where you're coming from. Because that at least just give the entrepreneur a chance to kind of reset their minds. And it has been successful for us because there have been instances where the businesses are struggling. Either they are struggling because of some cash flow constraints, because, non-tech, the returns are faster, but also at times the profitability is an issue in terms of margins. You suffer from cash flow issues. So there is probably a quarter where you struggle with salaries. Suppliers also won't deliver on time. You struggle with collections. So just having someone listen to you and probably say, why don't you do A, B, C, D? Or, okay, have you tried this? So just that also gives the entrepreneur some good mindset. Then there's one where we went ahead and the angel investor asked the entrepreneur to have a credit controller, because the entrepreneur was everywhere. I guess they always think they can conquer the world. And that one, unfortunately, meant that he was not putting focus on the key aspect of collecting after sales. So the angel asked him to just hire someone, a credit controller. And what he did is he asked the angel to help him with the shortlisting. He put out the JD. Eventually, that person came in. It's not yet rosy, but we are definitely seeing an improvement in their receivables, simply because there's now someone who's focused on just collecting. That also frees up the entrepreneur's mindset in terms of business development and looking at the other aspects of the business. So I think as an angel investor, I think those are the three aspects you have to kind of consider. So be a champion for the business, look out for what opportunities are there in terms of talent, and then at times just mirror the conversations that the entrepreneur is sharing with you.
Thanks. Very useful. Very useful. And I like especially the first one of being a champion for the company that you're making investments into. Just talking about them consistently in all the circles that you're in. So just moving the conversation, and incidentally, if you have any questions that you'd like to ask, feel free to put them in the chat. I am going to be picking questions from the chat. I want to ask your questions as we move along. So Steve, it's a general question, but I want to make it specific, which is, what are the fundamental differences between investing in tech and non-tech deals? And I asked that question. As I asked that question, the other question I have about it is this, especially in the continent, and then I'll be curious to hear what your thoughts is. We say that one of the key differences is that with tech you can get your 100x return. With non-tech, you should be content with, I don't know what the number is in this case, but we'll get to hear from you, Steve, in a second. If I look at that number, if today I took my cash and I invested in a government bond, especially I'm based in Kenya, I'll get my 16%, okay, now they're taxing that, but earlier in the year, they had a net government bond net returns, I think it's something like 17%, right? So then I asked myself, if I'm gonna get a similar return to what I'm getting if I'm putting money into government bonds in this case by investing in untapped, and on top of that, I have to do what Aurora just spoke about. I need to have the quarterly coffees. I need to be a champion for this company. But with the government, I don't have to be a champion for them. I don't have to have a chat with anybody. If anything, I just relax, and every quarter, sorry, every half year, because that's when they pay the interest, my bank account, there's something that happens with my bank account. So what are the fundamental differences? And then the question is now, as you're thinking about those fundamental differences, then why should you actually make an investment, especially taking into account then the fact that the return dynamic is not the same, so to say. A loaded question. Feel free to take it from any angle, Steve, and then Anne.
Very loaded. So now you look at that means I need to do like an asset allocation course. But let me start with a simple answer to your first part of the question, which is traditionally, obviously, as an angel, you expect intake. Angel intake, you expect something quite high, 10, 20, 30, 200, 1,000% return or multiple, even better. That's for sure. So I would say typically, when you look at private equity type, because there's a lot of layers to it, but I would say a good, decent return for a not-tech deal is 5 times your money. That's a decent return. Most private equity funds would have probably on an investment gross multiple of 3. If they do a fund at 2.1, they're happy. And then can correct me if I'm wrong, but these are kind of the kind of scope. Now the question is on the asset allocation. If you are in Ghana and then your government bonds have been cut by 30%, that return you're not going to get. Right? So your environment has a big effect. If in Kenya, touch wood, it doesn't happen, but something around default happens, your idea of a secured asset, which is government treasuries, will go through the roof. And then suddenly you find all the pension fund looking for what they call non-traditional asset, which is alternative assets. Okay. So if we take it back as an individual, what can you do? And Arowa talked about all the hand-holding, the calls, the pushing the companies or opportunities around. It's a lot of work. So I would say typically an angel investor, beyond the financial return, also wants to give back to the society to some extent, right? That's number one. And what I usually tell people, and not many people know, but I was actually a personal finance advisor in more than 20 years ago in the UK. And what I used to ask people is, look, you want to do these kind of risky investments, but I'll ask you 3 questions. One, do you own your house? Very simple. Do you have 6 to 12 months cash at hand if you lose your job? And then after that, what was your risk return profile? And Anne talked about it, right? It's a risk return profile or your risk rating profile. And even banks, when you want to do investment, they'll ask you. I think these are important things to ask. So again, on the differences is really difference of perception, your willingness to do a lot of work. But I would say that generally speaking, when you want to do non-tech deals, please don't do 10 of those because you will not be able to handhold them as an entrepreneur, as an angel investor, and you're going to have challenges in really supporting all of them. So what I would say is that typically a tech investor can probably invest in more, and actually it's recommended that the risk distribution should be minimum 30 companies as a tech investor so that you start diversifying. And you can go all the way to 100 or more for some of the funds we know. But typically, if you're doing a non-tech investment, 2, 3 are enough because remember what Arowa said. You need to be hand-holding them, right? You need to do a lot of work to create the value to exit. Again, our environment is a bit particular because having such high yield on non-risky assets, safe asset, traditional asset like government treasuries is unusual. It's not something that is typical in the financial world. this is the environment we're in. So that means that I need to figure out, okay, what is your play? If you believe that you put some of your money into those treasuries, fine, but then put some in those other ones because you never know who's going to pop. You may be lucky and get a Java exit or any other one, which you don't get as a government treasury. So again, so all about diversification, asset allocation to make you, diversify your asset if you can, and therefore benefit from both sides. I'll finish with one thing, a product that I thought about. Unfortunately, I was busy doing other more interesting things. But back in the days when I came back to Ghana in 2015, I thought about a very simple product. We used to sell our high net worth clients in Switzerland. I was based out of Geneva. And I'll make it very quick. Let's say Anne is my client. She wants to invest 100. Fine. I'll say, look, and she tells me, oh, I want my 100 back in, let's say, 8 years, and I'm happy with 2% return. Good. So what we used to do, we would take the 100, put 70 to 80 in a government treasuries, an 8-year one, so that by the year 8, the 80 or 70 becomes 100, correct? With the dividend and stuff, it becomes 100. The 20 or 30 difference, we would invest in more risky asset to be able to generate at least the 2% she needs per annum, but I actually will generate probably 20%, and then we take the difference. So it was called structured guaranteed product, capital guaranteed product, because we guarantee the capital back 100, but then in between we had the opportunity to do so many things, and we made a lot of money. In a way, that I think is what the type of product that you can build for yourself. You invest in government treasury or real estate, it gives you stable cash flows, and then the little money you have, you can try yourself at that, non-tech deals and obviously tech deals. Yeah.
I like that in terms of thinking, because actually we do recommend that as an angel investor, you're literally just putting 5 to 10% of your total net worth, excluding the value of the house that you're living in. That's one of the key things we emphasize when you speak about angel investing strategy. Anne, to you, same question, right? What have you seen as any additional fundamental differences between investing in tech and non-tech? And again, back to the question I asked at the beginning, why should you participate, especially taking into account the kind of return expectations that you will end up generating, bearing in mind where we are in the continent, where there's other, I guess, relatively safer. I don't know that they're safe now anymore. After Ghana defaulted, we don't know what's safe anymore. Relatively safer investment opportunities that you could take advantage of. And
you know, I'm listening to Sir Steve, and he's talking about, you know, you need to own your own house and have 12 months worth of runway, and I'm wondering if I'm on the wrong call as well. And you know, earlier this week I was at a conference and someone talked about you know, Sierra Leone pricing their government paper at, you know, with a 40% return. And so as Sir Steve said, if you're looking primarily to get returns, or to paraphrase, primarily from, you know, government bonds, you know, T-bills and other forms of government paper, then you should also realize that 17, 20, or 40% is anything but risk-free. And that if that is your ideal portfolio, then you are also probably like me on the wrong call and should drop. And so I think just, you know, I think really similarly, there are a lot of similarities between tech and non-tech investments, just in terms of the fundamentals. But it also boils down to what your risk appetite is, how much time do you have to do the hand-holding that Aurora mentioned, when do you need your cash back as well. So some of the similarities are, you definitely want, whether you're investing in a tech or non-tech company, you want to have a good team, right? You literally want someone that you can trust, someone who trusts you as well. So there's a mutual trust relationship. Somebody who will pick up the phone and tell you things are not going well, I need your help, as opposed to finding out 1 month or 1 quarter later. I think that's one. Two, you need to, in addition to having a good team, I think really think through investing in a company that has either good controls or is willing to put in the right controls because you need to be able to trust that the cash that's coming in is what is truly reflected in the accounts. And we're not really even talking audited accounts, but sometimes you need to be able to say, look, you only have a POS system. We need to upgrade you to something simple, like Odo, a very simple, ERP system, so that you can generate a very basic management accounts. You don't want to be going through, as we have done as investors, you don't want to be going through a PDF of a bank statement to understand what the company's financial status is. You want to be able to graduate them or really move them to having good, trustable management accounts, particularly for cash-heavy businesses, where not everything is on M-Pesa, mobile money, or not everything is going through a bank account. So while I think there are a lot of differences, some of the fundamentals really stay the same regardless of whether they are tech or non-tech, and that's really around, I think, trust, governance, the market. It should be, like a fairly stable or a growing market. I think you don't want to invest in, I don't know, Casio calculators when everyone is using their phones, right? So making sure like it's a stable and or even ideally even a growing market. I think those are some of the things that remain the same. But some things that will be different is that, with a tech deal, you're more likely to look at the top line revenue before you invest, and that's also a function of how you'll exit. Whereas with a non-tech deal, you definitely want to be looking at the bottom line. So how much profit are they making, and true profit, ideally, they are cash flow positive. I think another difference is you probably will spend a bit more time looking at the balance sheet for a non-tech deal to understand where does the cash sit? Is it tied up in inventory? How are they managing liabilities? Whereas with a tech company, a balance sheet is probably almost all convertible debt when you think about liabilities, right? So I think having the balance between the two is important.
Thanks, Anne. And I like some of those aspects that you started introducing around just the due diligence and the key things to look out for. And Aurora, just maybe to bring you in here, when you carry out your due diligence for some of the investments that you make, how do you carry out your due diligence? What are the key things that you found to be, important to check? If someone was to ask you top 3, top 5 things that you always make sure I've checked these things before I make an investment. And traditionally, how long does that take before you end up then making an investment into this? Because with technology, we've come from a situations where at times you just jump into a call, people would say a couple of things, you get a pitch deck, the startup has already set the terms, and I don't know, 1 month later or a couple of weeks later, you already made your investments and so forth. Of course, we are moving away from that now. But Aurora, how do you carry out your DD and how long does that take? What do you really focus on?
Thanks, Steven. I saw I switch off my video. My Wi-Fi and my laptop, I think, were Harris supporters. Somehow they have failed to connect. So I don't know if you could just allow me to switch off the video and just use the audio.
Okay, we'll allow you. Thanks.
Thank you. Yeah, so, our due diligence takes anywhere. I'll share precedence. We have done due diligence in as short as 2 weeks on a transaction, and we have done due diligence as long as 6 months on a transaction. So it's anywhere in between that. And the key aspects are pretty much the same for us. We want to understand, most importantly, the sector that we are getting into. And along the way, given the learning curves we have gone through, we have a fair understanding of different sectors, because that's key, especially in the sub-Saharan markets. Most of these sectors are unpredictable. So you need to have some idea of how well the sector performs, and also what do the troughs look like in terms of the sector. So what's the strategy for the business? What's the entrepreneur looking at? We're always looking at what market is it targeting. And then we always look at operations. So operations entails the financial aspects of the business. As I mentioned, we typically want to use debt as our point of entry, and that requires a certain level of revenue generation. So they have to be able to at least show a certain level of being able to pay you back. So a lot of focus goes on verifications of revenues, whether it's bank statements, whether it's mobile money statements. Then also we look at the balance sheet, which is quite important. I think as Anne mentioned, the aspects you need to understand on the cash flows of the business. So how frequently does the cash come in? Does it come in monthly? Does it come in quarterly? If it's a school, does it come in thrice a year? Because that's when the students come in. So that's key for us in terms of the operations and the financial aspects. And then also the entrepreneur is quite key. I always, whenever I meet an entrepreneur for the first time, I always ask myself, how will he behave when things are going well? And also, how will he behave in case there is conflict between the two of us? So that's also quite important at the back of our minds when you're doing the due diligence. And then also, lastly, I know probably as angel investors, at times there's a focus on return versus the softer aspects of investments, which is mainly around the ESG. For example, we are looking at a furniture shop in one of the markets, and there's a lot of focus we are placing around the sourcing of timber, which is quite sensitive in terms of investments. So as an angel investor, you may think it's something that is small, but then you really don't want your name to be dragged through one or two bad episodes that may happen during the investment period. So for example, you invest in, let's say, a factory or let's say mining company, and then the next day there's bad press around it, and then your name gets dragged into that. So aspects when you're doing due diligence that you need to look at are not just aimed towards a return, but also what are fundamentals around this investment. Fine, I'll get a return, but will my reputation still stand the test of time after this investment? So the focus at times needs to be that broad. So it depends on how well these businesses are organized. And so that's why I said based on precedence, it has taken 2 weeks, but also it can take up to 6 to 7 months.
Thanks, everyone. I really like that point of ESG, which I think speaks to risk, right? So you're not only looking at just the return aspect, you're also looking at the downside protection risk in this case and the different aspects that, reputation risk that could come up in this case by participating in the transaction in this case. And maybe coming back to you, Steve Tawia. And as I mentioned, if you have any questions, feel free to ask a question. I'm going to pick them, but I still have a number of questions because I'm also taking notes here. I guess for me, two related questions is, and feel free to add anything on due diligence, but just thinking about scale, right? One of the key things, if you're coming from a tech perspective, is you're always thinking scale, scale, scale. So when you sit with a company, you're always asking, how fast can you scale across the country and across the continent, etc., etc. You've just walked into an untapped deal, and yes, scale is not bad, right? Scale is good. We did have a restaurant like Java that scaled across and has, I don't know how many restaurants and so forth. So how can you help entrepreneurs or disentangle this question of scale? Because I find that with most non-tech deals, you'll find someone who's pretty comfortable. They're just like, you're coming in, I'll give you a return. You should be okay with that. But you're coming in and you're looking at things a bit different. I mean, you do want to get the return, but you also want to see if you can multiply it. So you mentioned 5x. You're not going to get 5x if you sort of just put a debt instrument and sort of sit back and wait, right? That's the first part of the question. But then the second part of the question is exit and getting your money back. What instruments then do you use to make sure you do get your money back and you do participate in the scale part, assuming the scale does come through? Steve, and then we'll move to Anna after that.
So, in fact, when you were talking about the scaling, I was also thinking exit. So we landed at the same place. So what I would say is that both for tech and non-tech deals, actually, what are the rules of engagement? And I'm using the military term. What are the rules of engagement? So both founders need to know that you're not going to be there forever. And so even if you're a patient capital investor, especially in non-tech deals, you also at some point have to exit, take your money back and pocket it or reinvest it. But at some point, there has to be a separation or some sort of liquidity event that tells the investor, oh, I did the right thing. So what I we try to do very early on in a lot of our investments is to have that conversation with the founders to say, look, we want to invest, but we are a fund. We have a 10-year life, for instance. We need to exit. We need to figure out a way that after 6, 7, 5, 3, we don't know, years of our relationship, we need to take our money and walk away and help you continue with your journey. And so that has to be a conversation to be had from the get-go. Now, structurally, we can look at so many instruments, self-liquidating instruments, structured debt, and truly, when you're looking at a non-tech deal, and we talk about balance sheet, cash flow statement, etc., you need to figure out, okay, what are the economics of this company? How can this company make money? And while it's scaling, what is going to break and what is going to make money? Once you kind of understand the mechanics of the company, then I think the instrument you're providing should be in adequation of with the founder. If they want equity, debt, mezzanine, whatever they want, revenue share, like some other funds do, or there's no immediate answer, but you give an option and then see what it looks like after. So a typical case will be a hybrid instrument, a convertible note. You say, look, I don't know what this is now. I'm not sure. Let me give you an instrument, a convertible note, with a certain level of conversion, a multiple of EBITDA. It can be a multiple of revenue, but it's more complicated. So that by the time the convertible is maturing, either you say, okay, I extend it by 1 year, or I convert to equity because you believe of the growth, or you just take your money back and go. So that gives a lot of flexibility both for the entrepreneur and for you. So depending on the instrument, that's what you can look at. I guess one of the things I find on the continent sometimes is that those non-tech deals founders or established businesses, a lot of them are established businesses with maybe generational ownership. They are not always very sophisticated on the type of instrument. So sometimes as a non-tech deal investor, we actually need to educate the management team on what is it that they're going to sign up for. Because the worst thing, I mean, I've heard it so many times. Sometimes founders say, "Oh, we signed this thing, but we didn't see this particular clause in written fine prints that meant that actually what they thought they were going to do to kick you out cannot work." Right? So there are a lot of other things like that. So I think, the rules of engagement from upstart and transparency on how this can work is very, very critical. I think I'll finish with one thing, which is the perception of investors by non-tech deals, owners. I think most often than not, and I don't want to generalize again, tech deals are much easier because entrepreneurs come with the knowledge that investors are going to invest equity, there's going to be some transaction, etc. Most, I would say, brick and mortar non-tech deals tend to be owned by people who have less sensitivity to that. So that means that not only you need to do education, but also you need to walk the journey with them in such a way that they know in a way that you're not going to take over their businesses, right? Because this is the perception, in Africa, a private equity investor is actually a vulture investor. They want to take over my business, take it away from me, kick me out. It doesn't happen, but for various reasons, but it is not the norm, right? So that's fear on the other side. So, if I take an investor, the investor is going to take over my business, should be removed from the equation so long as there's clear communication. Yeah.
Thanks, Steve. And I just like that point around non-tech brick and mortar type of owners of companies. They've not gone through 100 accelerators. I don't know how many pitch sessions, which means that you're going to have to do a lot of education before they sort of like understand and you align with them. Probably the only education they've gone through is from their banker, right? And so if you come with a loan instrument, they're like, I understand this. Let's move forward from that perspective. Anyway, and let me bring you in. And I guess a same question, question of exit, and just this question of scale, right? Because I mean, you're coming from a perspective, and I did mention this, that scale is important for you because that's how you create your leverage from an equity perspective, right? And I don't know whether you just come in and just tell them, the brick and mortar owner, I just invest in a debt instrument and sit back because that's what you're used to. But how do you navigate that element, or you want to push certain elements because you want the company to grow, but then also to get some of that return? I don't know what's been your experience around that space. And we're almost winding up by the on the Q.
Okay. Yeah, I mean, those two are so closely related, the question around scale and exit, because ideally, one way, not the only way, but then one way in which you increase the value of your exit or your exit multiple is through scale, right? So they're very closely intertwined, but scaling is hard and exits are even harder, right? I have lost a lot of money, both as an institutional and as an angel investor, just because of companies that didn't get the scale question right? This is probably why I don't own my own home. So was Steve, by the way. But no, but like, I mean, in reality, right? So you have company X and they say, look, right now we're operating in Nairobi. Let's move to Dar, right? And it's like Tanzania is such a different market, like Kampala is such a different market. And you're not going to be able to scale, frankly, if you don't have, whether you're a tech or non-tech business, unless you have, positive unit economics. If you're selling, every time you sell a glass of water, you're losing money. Don't say I'll start making money once I sell 1 million glasses of water, right? Like it doesn't work. So you need positive unit economics. I've seen companies just, lose money scaling because they, in addition to positive unit economics, they just have poor controls, right? Like they don't understand where money is moving in and out of the business. And maybe they were just moving from Nairobi to, I don't know, Eldoret or Kisumu, right? Not even like a large expansion. So I think having the fundamentals in place is really important. But one advantage I think non-tech businesses have over the tech is they may not have the controls, right? But usually they have the unit economics, right? Because they are forced, generally speaking, to be, either cash flow positive or at least EBITDA positive. That's one. And then two, you have a much broader set of instruments that you can use. As was mentioned, debt is a really nice, clean, simple instrument, and there's different ways you can structure it. Such as, look, you're investing in a non-tech business, you just say, look, I'll give you, $1, just return to me $1.50 in 2 years, for example, right? I mean, I'm oversimplifying, but it's something like, so Steve said, that they understand it potentially then, lowers what your return profile is. You're not making 2x, right? You're making 1.5x, but you're making money. And not many people, individuals, or even funds can point to a strong track record of making money, and having simple instruments like debt or other self-liquidating mechanisms for, simple non-tech businesses can actually be a way of, we've talked about having, risk-adjusted portfolios of actually ensuring you have, a layer of semi-guaranteed or at least low-risk returns.
And light bulb moment for me is when he mentioned that most non-tech deals always generally have the fundamentals right? Because they're not going to get some funding from outside, right? And if they get any funding, it's a loan, which everybody expects for them to pay. So unit economics is one thing that they always have to get right. All you can do is try to optimize it a bit better for them so that maybe they create better margins. A very interesting point. So we're coming to the end of the session. But I want to ask just a few questions, very quick. And Aurora, I'll start with you. And I think for me, the question for you is to share with us one recent successful non-tech deal you've been involved in that's been runaway success. If you can share the story behind that, the sector, and so forth, that would be interesting. And maybe just share, more importantly, what do you think made it a successful deal in this case? Like, what did you do as the investors to contribute to that success? So, Aurora?
Yeah, so I was thinking of which one to pick. Probably agriculture.
Aurora, I like that. Aurora is just like, I have so many. If you have to check
No,
in
I
the
mean,
answers, they'll be like, I think I only have one to pick from this. So anyway,
I
go
had
ahead.
promised to give you one of the unsuccessful stories. Hopefully, time allows, and or probably another
Please give us an
session.
unsuccessful one, what you picked from it, and then probably, of course, a successful one, and what you did and what lessons came out of it.
Yeah. So for the successful one, I think, as I mentioned, agriculture and to be specific, coffee. And at times I'm hesitant to take credit for. We're hesitant to take credit for the success of this business because for this transaction or for this particular investment to be successful, a number of ducks had to align, both on our side and the side of the entrepreneur, on the side of the geopolitics, on the side COVID happened. It was a plus for him. On the side of the pricing has been stable. So it's a business. I think as of 2020 was doing a turnover of $900,000. Year to date, 2024, this is 4 years later, it's doing $50 million in terms of turnover. So you can imagine that kind of return in a period that involved 2 lockdowns, a period that involved a number of recessions across our markets. But the one thing probably we did right was the structuring of the transaction. And I guess what Anne and Steve had shared earlier is something as angel investors you have to keep at the back of your minds. Being creative in the way you structure these transactions in terms of exits. So do you make it self-liquidating? Where on a periodic scale experiment comes towards you, do you make it some sort of revenue share that's capped? Because most times getting a huge chunk out of these businesses is a little bit hard. So it's about how creative you are as an investor. So the one thing we're very creative with this entrepreneur is we did a lot of short-term investments initially. And then as the market stabilized, we kind of kept on increasing those to 1 year, 2 years. And the other aspect was also we're very keen on non-capital aspects of the investment. So getting him fair trade certification, trying to improve his supply chain between the farmers to the grading areas, trying to ensure that he has a good inventory in terms of container availability. So those aspects somehow is what we did on our side. On the entrepreneur's side, I think was very receptive. He was eager to learn, went through a number of trainings with his team. And as I say, I'm hesitant to take credit for the success of the investment. There's a saying, success has many fathers, failure is an orphan. So anyone could claim that I'm the one who probably did this. But also in terms of the sector, I think post-COVID, the other markets struggled, especially in South America, Brazil, and I think Colombia, coffee as well. So those supply kind of constraints meant that the global markets had to turn to Africa, and Uganda and Ethiopia were direct beneficiaries for that. So when I say a number of ducks had to align for the investment to be successful, that's what I mean. We played our part, the entrepreneur played his part, the geopolitics also played its part. Luckily, the governments insisted the word essential became something of a norm. So coffee was one of those essential products, and coffee trucks were allowed to move day and night throughout these lockdowns. So even the policy was in our favor. So all these things somehow have to align for you to say, yes, this has been successful. And probably that's also speaks the fact why you need to diversify as an angel investor, because very few a time will all these things align in one investment. But it's always good if in probably 2 or 3 investments, whether it's take or non-take, this works out. And then the other ones go through the normal processes that businesses go as they reach scalability.
Wow. You are going to share very quickly in, I guess, a minute, one that was successful and what you learned. But maybe a segue question in the middle. That's a 50x growth. That sounds like tech. I'm sure all the non-tech guys are just like, whoa, wait, 50x. Out of that 50x, what return are you making out of that? Because that's a pretty decent growth for the portfolio. So maybe just if you can answer any of the questions I've asked, and then secondly, just about that element of one unsuccessful deal and what you learned.
So, on the return, I would say it was decent without being specific. I hope that's a fair answer. Yeah, so
keep going.
I was saying I hope that's a fair answer. But yeah, that's how decent the business has grown in terms of the upscale. The unsuccessful one, again, quite similar. And the challenges have been around what I hinted at, trying to have a one-size-fits-all model across different investments. Just because it worked here, it doesn't mean it will work in another market. The different dynamics that different markets present. So if you've been successful in one particular one by implementing all these within the entrepreneur's business, it won't work in another market. So the one lesson, at least we have learned, is you have to look at each investment on the merits and the demerits of it. And I guess we are human beings and try and be as objective as possible when you're structuring something that you think will work for that business. So the one that was not successful, we tried to copy and paste across markets, and we got our fingers burnt. So that's the lesson from that.
Thank you very much, Aurora. Really appreciate. I can bet if you're a tech investor and you had a 50x growth in your portfolio, you would have been like, yeah, we did a lot to contribute to that growth. So Steve, to you, and then we'll finish with Anne. What spaces for you are exciting as you think about non-tech deal, going forward into the future?
Fine. I thank you for the question. I wanted to comment on Aurora's take on it, which I really liked. In fact, when I look at what he described about the opportunity that COVID presented, etc., I think you mentioned there's a bit of luck, work, and then ecosystem, environment, so many other aspects. I think that's fundamental. That's why we were talking about risk diversification before. I strongly believe that anyone who wants to do a tech deal should try and do maybe their first tech deal, non-tech deal, sorry, non-tech deal in a defensive sector. So a defensive sector is a sector that, rain or shine, we all need it. So I'll give you my other example. So my first example was actually food, as I mentioned, right? She had other issues, etc. So that, at least I got my money back. But in Ghana and in Kenya, I focus on food businesses. And food, unless you're having issues with KRA or you're not positioning yourself very well, it's okay, except for if you look like Pune or others, which are more tech. If you do a restaurant, like people eat nyama, fries, like this is a cash flow business, like you can make. The critical thing is plug the holes. We know how money can go out of those businesses, but do that. Hospital, clinics, dentistry, school, like these are defensive sectors where rain or shine, people need it. That's what I would do first. I think where people failed, and I failed, to be honest with you, and again, it's because I did not set up enough controls, right? I invested in a young man who wanted to set up a bee farm in Ghana. There's a region called Afram Plains. Put in the capital, bought the beehive, bought the material, and then we're going, and he's bringing us, our own liters of honey, propolis, all the side products, only for us to realize that essentially the manager was siphoning so much money out of the business that he managed to get a very lavish wedding and all things like that. And so, sometimes, you invest in businesses, as I said, that's what I was saying before. When you invest in a brick and mortar kind of businesses, be there. Go and hang around, set up controls and processes, etc. And with the technology today, you can have cameras, etc. Even then, people will say, "Oh, the camera broke," and that's how they manage to see it, right? So anyway, there's so many areas. So again, failure teaches you something, and then you get comfortable with certain business you can invest in because you say, "Oh, in this kind of business, I trust myself and my team to be able to put in place enough controls to make sure that the money is used properly, and then you can use that and exit." Successes are boiled down to luck and sometimes work as well. It really depends. Yeah.
Thanks, Steve. Yeah, indeed, be there on location because you never know what's happening on the ground in this case. Okay, Anne, over to you for your closing remarks. And I guess same question. Steve has told us about investing in defensive sectors for your first non-tech deal. For you, what sectors excite you at the moment when you think about investing in non-tech deals? And if you have any closing thoughts for us.
Yeah, so I mean, I think there's sectors that excite me, but they might not be a good fit for you as an angel investor, right? And so my rule of thumb is just invest in what you know, like simple, right? So if you're a banker, you might want to invest in an MFI, right? If you're a doctor, invest in a clinic, etc. Like, don't pay the school fees on learning how to be an angel investor and learning a new industry and learning all these things. Like, just minimize your risk and minimize your downside by investing in what you know, because then that also allows you to add value and increase the chances of success in a deal. And if you don't have any specific sectors that you are particularly, an expert on, then teach yourself. Like, so Steve said he spent COVID learning, AI and machine learning, right? So just dedicate yourself to learning something, being very good in a craft, and ideally your returns will be somewhere around the intersection of what people need, which is what Steve is calling a defensive sector, and where you're enjoying yourself and making money. And so I'll actually just have that to be my closing remark, is that if you can invest in line with what they call, the ikigai principle, right? So what you know, what people need, what brings you joy, then I think it's a very simple recipe, quote unquote, to be a good angel investor.
I like that ikigai. What you know, what people need, what gives you joy, right? I got that right. I love it. That's a good close to our session today. Thank you very much, Anne, Steve, Tawia, Aurora, for a very insightful session. I think I'm just looking at the chat, and there's lots of people who are saying that's been very insightful. Please do not leave yet. If we can just show us some appreciation to our panelists. I think there's some emoticons. I don't know how they work. We can just maybe have a clap for our panelists, or if you want to celebrate whatever you think you're able to do. Guys, thank you very much. As you can tell, people have really appreciated this session. So we're just gonna move to the last bit of the session. And the last bit is just some few announcements we wanted to make before we close in the next 5 minutes. I am gonna invite our new program manager, Fiona, to just share her screen to put on her video. That's one of the key announcements we have. We have a new program manager, Fiona Kiruja. In the office, we call her Miss Sunshine because she brings sunshine into the office. So I allow her just to say something about herself, share her screen, and then just take us through a few announcements that you wanted to make. But thank you very much to the panelists. Fiona, over to you.
Hi,
Fiona sets
everyone.
up.
Hi,
Fiona,
hi.
maybe you can go to presentation mode.
Yeah. One quick second. Telling you, our village people were trying to find us today.
Indeed. Over to you, Fiona, and welcome on board to AAA, by the way. But over to you.
Thank you, Stephen, as we call him SG. Thank you, everyone, for joining us. Our panelists, I'm super excited to have been part of this conversation. I've learned so much. My notebook is literally almost filled, which reaffirms my passion for, angel investing, having been a failed entrepreneur once or twice. So I definitely feel the pain of entrepreneurs, and now I'm really seeing how important, angel investors are. I wouldn't have made it to the point that I did as an entrepreneur in my days, without, angel investors who believed, they say fools, friends, and I guess now it's angel investors. Hey, I'm super excited. Over the years, I've been working with super high impact programs. So just to name a few: Societe Generale Accelerator, Airbus BizLab, Innovation Managers Executive Learning Program, and worked with incredible organizations such as Meta, Hindsight, Mest Africa, and now really excited to be leading the African Angel Academy alongside the incredible Stephen Gugu and the Viridian team. So I'm super excited to be running this. So exciting announcements, really, really exciting announcements. First and foremost, to honor, Steve Tawia for being part of recording the investing in untapped deals module. Let me tell you, if I tell you this module is incredible and gives you the full scope of what you should do, I believe after recording, I think I will be an untech investor. And we also have the safe instruments, understand what kind of instruments you could be using to be able to ensure your safety as an investor. What can you do? How does it work across different industries? So be sure to have a look at that, and all of this will be available on our website, our new website, which will be launching in the coming week. So keep an eye out on our socials, countdown, and keep the drum rolling. We have 14 new modules in our courses. So with the 2 new modules, the full foundation course is now up till 14 modules, and you're able to take this in, bite-sized options, a curated learning path, where you can either take the full foundation course or follow a curated learning path, which we've segmented into the beginner's track, intermediate, and advanced. So if you're super green, have no idea what angel investing is, have no idea how to figure out how do you even find your first, module, how do you find your first startup, the beginner's track is for you. And if you have your foot wet in the industry and know what to do about angel investing, have an inkling about the industry, feel free to upskill in our intermediate track and learn more about how to deal structure, how to mentor, how to really set the valuations, what are the different ways that you could deal structure, which is super important. And if you're experienced, super experienced, like our panelists today, feel free to dive into the advanced track where you can learn more about the investment governance, how to exit, how to form an angel group, and also dive into the syndication, the non-tech investment, module, the safes, and also, really learn how to, syndicate if at all. So yeah, in addition to that, for our alumni who are on the call today, we are excited and to have you. We couldn't have made it this far without you. And because we value you so much, we will be introducing an alumni membership, which will be an annual membership that will allow you to access all 14 modules throughout the year. So, if you need a refresher, subscribe to the alumni membership and get access to all the content as well. Exciting things coming up. So one, new aspiring angel investors, feel free to start your journey. I'll give you a second to scan the QR code to express interest. We will be announcing soon our our call of applications for the February 2025 cohort. So if you're interested in being part of a self-sponsored cohort program, please feel free to scan the QR code on your screens. We will also share an email with these exciting updates and a link to express interest, just in case you're not able to. And without further ado, thank you everyone for joining us today. Stephen, it was an incredible moderation. Aurora and Steve Tawia, you guys have been incredible and are immensely appreciated. And of course, to our esteemed audience, thank you for sparing this time and spending time with us this evening. You could have been doing a million other things, but decided to join us today and learn more about navigating non-tech investments and opportunities as aspiring angel investors. Everyone who's sent in their LinkedIn, I'll be sure to connect and reach out. So let's have a chat and reach out. Thank you.
Thanks very much, Fiona. Welcome on board. Thanks to the panel. I see that also David has joined us. David is also one of the core facilitators and key partners at AAA. So David, if you want to say hi as people are shutting down for the day, feel free to just unmute yourself and you can just say hello. But thank you very much to everyone. Do have a lovely evening. I think maybe David has stepped away from the desk, and see you for the next Angel Connect, and we'll keep talking. And if you aren't already, if you're joining us in Cape Town, we did speak about the alumni drink up or sundowner, which is going to be happening on the 27th, alongside is it the opening evening for the ACs? So feel free to reach out to us for that, or we'll meet you down in Cape Town in November. Thank you, everyone. You have a lovely evening.
Thank you, everyone.
Bye.